APRA just introduced their first ever debt-to-income lending limit. And if you're a property investor, you need to understand what this actually means for your borrowing capacity. From 1st of February 2026, banks can only approve a maximum of 20% of their new loans to borrowers with a debt-to-income ratio of 6 or higher. Now, here's what's interesting. Right now, only about 10% of the new investor loans are at a DTI of 6 or above. So we're nowhere near that 20% cap, which raises the question, if we're not even close to hitting the limit, why introduce it at all? I'm Naveen Merani. I've worked in private banking, commercial lending, and I've seen how regulatory changes like this play out in real time. And I can tell you, this isn't about what's happening today. This is about what APRA thinks could happen when interest rates eventually fall. So let me break down exactly what this means and why it matters, and what you need to know if you're building a property portfolio right now. As a quick refresher, your DTI or debt to income ratio is the total debt that you have divided by your total gross income. So if you earn $100,000 a year and you want to borrow $600,000, your DTI is 6. If you borrowed $700,000 on the same income, your DTI would be 7. The higher your DTI, the more debt you're carrying relative to what you earn. From the lender's perspective, that means a higher risk. Now, APRA has introduced a rule that says that banks can only lend to borrowers with a DTI of 6 or higher for up to 20% of their total loans. And this 20% cap applies separately to two groups, owner-occupiers and investors, which means every bank has to stay under both limits. So say a bank issues 5,000 owner-occupier loans and 3,000 investment loans per quarter. With the new cap, this means that the lender can only approve 1,000 owner-occupier loans and 600 investor loans at DTI 6 or higher. So let's say you're an investor earning $120,000 a year. You already own 2 investment properties and you're trying to get an approval for a third. The bank calculates your total debt at $780,000, your income at $120,000, so your debt to income is 6.5. Now, if the bank still has room in its 20% bucket, they might approve your loan. But if the bank is already at 19.5% of its investor loans above DTI 6, they're going to decline it. Or they'll cut your borrowing capacity to keep you under the DTI 6 threshold. Right now, investor loans above DTI 6 sit at around 10%. Owner-occupier loans above DTI 6 are even lower at about 4 to 5%. So we're nowhere near 20%, which makes people ask, why introduce a cap at 20% if we're not even close to hitting it? And the answer is, APRA is not solving a problem today. They're preventing a future problem. Think about what happens when interest rates eventually fall. Borrowing power rises and people start stretching their debt again. Investor activity picks up and DTI ratios shoot up. We saw this exact pattern in 2021. When the rates were low, DTIs above 6 jumped to around 25%. Banks were lending aggressively. Investors were stacking debt and household indebtedness was climbing fast. APRA is making sure that can't happen again. So this is a preemptive move. Now, let's talk about why this feels like they're targeting investors specifically. Because it is. Investors borrow much more aggressively than owner-occupiers. They often reach DTI levels of 7, 8, even 10 times across multiple properties. They use lenders that stretch borrowing power, and they can snowball debt much faster. APRA has been very clear about this. They've said that if signs of a material buildup in vulnerabilities driven by strong investor growth emerge, they'll consider additional investor-focused lending limits. So the 20% DTI cap is just one tool. If investor lending keeps surging, there could be more restrictions coming. Maybe a cap on investor loan growth, like we saw in 2014 when APRA imposed a 10% annual investor loan growth limit. Right now, investor credit is rising at its fastest pace since 2015. So APRA is watching this closely. And here's what this means for you. If you're an investor trying to scale a portfolio, you need to understand the lending environment is tightening. Banks will start getting more cautious about high DTI lending. They'll tighten their assessment policies. They'll scrutinize rental income more carefully. And if you're trying to borrow aggressively, you might find yourself hitting walls that weren't there 12 months ago. So does this rule actually change anything today? Honestly, not really. The real impact will come when interest rates drop in 2026 or 2027 and borrowing power surges again. So if you're an investor planning to scale aggressively, you need to be realistic about the environment. Banks are going to get more cautious about high DTI lending. You might need to structure your purchases more carefully, spread them out over time, or use different lenders. Look, this is a significant shift in the lending landscape. APRA's decision to introduce a DTI cap is the first of its kind in Australia, and there could be more changes coming if investor lending keeps surging. But it's not the end of property investment, and it's not the end of scaling a portfolio. It just means the strategy needs to be smarter. The investors who understand how DTI limits work, who structure their borrowing carefully, who work with knowledgeable professionals, those are the ones who will continue to build wealth regardless of regulatory changes. If you want to explore what your borrowing capacity actually looks like under these new rules and how to structure your next purchase, I've left a link below to book a strategy call. We can look at your numbers, your goals, and map out the clearest pathway forward given where the market is today. Otherwise, I'll see you in the next video.